Guys, sorry about that. The link had closed, but it's the same link. So for those with whom I've lost, can try to tap them. But let's continue. So this is how you end up with this cost of preference shares, redeemable. Okay, I hope you have the same values because I tried to compute that. So you can continue. So you're done with preference shares. Now we go to equity. Okay. Now for equity, it's the same thing, really. Same formulas, just apply. Okay. So if I go to the formula of equity, just bring it forth. Yeah. Okay. For equity. Okay, this is the formula. So I'm saying that it is div1. Div1 is dividend 1 or expected dividends. Okay. Like I already said, expected dividends are dividends you plan to pay. You've not paid them yet, but you're planning to pay them in the future. Okay. So usually they give you the past dividend. Okay. We're supposed to have the ones in the future. Then P naught, we are aware, and the G. So we go and extract the information. So div naught, div1, sorry. Whenever it's not given, it's the same as div naught, which is the old dividends that they paid, okay, into 1 plus G. That's if it's not given. But if they say expected dividend is this, use the way it is. Okay. So let's go and see from our question. So they're saying you have equity capital of 3,000. Now, once you say 3,000, that is F naught. Okay, not P naught. Okay. Fully paid 15,000. Well and good. But the note on it, they're saying that addition, the next expected. Well, I say the next, or they say expected, it's the same thing. Okay, the expected dividend on equity shares is 350 per share. So that's your div one. It's given expected dividend. So you say, in this case, it was given 360 per share. Okay, then they say that the dividend is expected to grow at 8%. That's not happening. So what we are interested in. They're just telling you that the G is actually 8%. Okay. Then the market price, which is the P naught, is also giving us 4,000. So here you're speaking, is it per share? If it's per share, then you're saying your P naught is per share. So your dividend must also be per share. That's the only trick. Okay. So you don't have flotation costs, then give you. So F naught is 0. All right. In this case, this is flotation cost, not face value. Take note. This is what, let me even emphasize. These are flotation costs. Okay, but they were not given in this case, so it is 0. What does that mean? It means that when you come to your formula, okay, I want to emphasize this. They're saying that this is expected dividend. Okay, there's when they tell you that dividend paid 360. That's different. If they say dividend paid is 360, that's not expected. It has already been paid. Okay, that's all the information. So that will be div naught. Okay, try to get the difference. So whenever I give you div naught, then you're supposed to apply the plus G, 1 plus G to give you the div 1 or the expected dividend. Okay, so we're here now. We substitute. So if you substitute div 1, you already have it there. It is 360. Okay, then P naught and F naught. P naught is 4,000. Okay, and F naught is 0. Then the G is also given as 8%. then you apply. Okay. So how we compute is you first deal with this, the division first, then after you add the G%. So therefore we have 360 divided by 1,000. Okay. Then you add 8%. So this one is 17%. Okay. So any questions so far? Because on dividends. Okay, sure. Okay. So the hardest part of weighted average cost of capital or computation of cost of capital is usually to determine the specific cost of capital of each item, of each line. Once you have that, then you, as your 3 quarters away. About the dividend, someone asked about the dividend again. Can pardon that. For the dividend, we're saying that the formula for equity says that you have div1 over P naught minus F naught, the whole thing plus G. Okay. Now div1, I already say that it's the same as expected dividend. Expected dividend means that it's something you expect in the future. It's not now. Okay. So if they give you anything like we paid dividend or the last year's dividend was this, that is div0, okay, or div naught. That is past dividend, not the one that we expect or the future dividend. So if they give you that we paid dividend or last year's dividend was this, we are saying in that regard it's called div naught. And when they give you div naught, you add or you multiply it by 1 plus G so that you get div1. Okay. However, if they give you div1 like they did in this question, they will tell you that expected dividend is this. Okay. They're telling you that the expected dividend is this. That means that that's the future dividend, and hence that's div1. Here they say that the next expected dividend, whether they say next or they say expected, it's the same thing. I think they wanted to emphasize just to remind you, but on a normal day, it's just the expected dividend. On equity shares is 360. That statement alone is div1. Okay, it's div1. So that's why I didn't have to add plus G, what, just got it the way it is. Rebecca, I hope I've answered you in that regard and the rest. Yeah, feel free. Can say what you want to say. Oh, the dividends on preference shares, those ones are usually fixed. Preference shares have a fixed rate. As a matter of fact, one of the difference between ordinary shares and preference shares is mainly the fact that the rate or the dividend is fixed for preference shares, whereas for equity or ordinary shares, it's not fixed. Okay, so for preference shares, it is fixed. The way it is, they will give it to you in the question. Yeah. Okay, they say that 11% of preference shares, preference capital is 10,000. Did I say 10,000? Apologies. 11% preference capital, $10,000 each. Fully paid is 1M. This statement here has two things. One, it has the rate at which they pay dividends regarding preference shares, and also has the per value or the value per single preference share of 10,000. Okay, so the interest rate was given for preference shares. For you to get the dividend that were paid for preference shares, this is getting the 11% times the per value. That is if you're using per share. But if you're using totals, then you would say 11% times 1 million. Okay, I hope I've answered you, Rebecca, in that regard. For which answer have we got for preference shares? The answer is take you there. Preference shares, yeah. We got 15.4%. So guys, if you don't have any questions or any other question, you can continue now and look at the work weighted average cost of capital. Okay, because weighted average cost of capital, like steps. Step 1 says that you identify, you compute the cost of capital for each item, okay, meaning for every debt item and for every equity item. And then you determine what you call the proportion, okay, or the proportion of each debt item or equity item in the pool or in the cost structure, okay, in the capital structure. And then after you have each proportion, then you attach the specific cost of capital to each portion, and then you have your weighted average cost of capital when you aggregate the result. Okay, what am I saying? Let me share it here. Okay. So I'm saying for weighted cost of capital, I think I should put them up here. Okay, for those who like steps, saying that so we're saying that step 1, steps. Step 1, we say you compute or identify by the specific cost of capital. Okay, by this we mean that you get cost of bank loan, okay, cost of preference share, like what they've just done, cost of debt, cost of capital or ordinary shares or equity. What they've just done, that's the first step. And the second step says that you, of course, it is depending on what you have. The second step is you determine the proportions of each item in the pool, or you'd say the capital structure. Okay. What do I mean by that? You're going to see. Okay. Otherwise, what we do is you get the face value of each item, and divide it by the total face values, or the total face value for capital structure items. Okay. Then step 3, you just attach. Okay. Attach the proportions to the specific cost of capital in part 1, okay, what you got in part 1, in step 1. Okay, so that's the proportions that are in step 2. To specific cost of capital in step 1. And then later you add aggregate. So let's see how we do that. So I'll just draw a table. I have items, first value, proportion, specific cost of debt, and weighted. Okay, so you're saying you look at the item, saying you look at the first value, okay, which is in the balance sheet. Really, this is really in the balance sheet or the information given. Let me use the figures I've been using, which is the F note. Okay, let me just stick to face value. Because if not, we can use the value or the totals. Then what you bring here is the proportion. And then you bring the specific cost of debt, specific cost of debt and cost of equity. Then you have the weighted at the end when you add them together. So shall I start with the first lines, the way they are in order. I can answer the few questions. And are you recording? Because it works. Yeah, I am. So cost of equity, you come, first line is equity capital. So by doing this, of course, you're not doing anything, you're just trying to be organized. So you bring the face value. This is going to help us to get step 2. Otherwise, step 1, we already have it. Can I do in step 1, which is cost of debt or cost of capital? So for equity, if you check cost of capital, we got it as 17%. Okay. So you bring, and you say 17%. Okay, that was the specific cost of capital. This is step 1. Okay, then you bring the face values to get the proportions. So the face value for equity is 15 million. Okay, I should first bring all those because I'm going to disturb. Then preference shares. Preference capital. The specific cost of debt for preference shares, we got it as 15.4% there. So we bring it 15.4%. Okay, the face value is of course given here. It is 10, it's 1M. Then the next one is retained earnings. Okay, I forgot this one. Now for retained earnings, allow me to talk about it. Retained earnings is an equity item. Usually it's the same as this one here. It's the same as cost of equity. Talking about retained earnings, sorry about that, because I'm taking it back behind. We should finish this part just to. Okay, I'm saying these are retained earnings. It's the same as equity. The only difference is that for it doesn't have flotation costs, because retained earnings are already in the business. You're not going to issue shares. You're not going to issue prospectus. Okay, you're not going to advertise to have this money. So you don't have flotation costs. So it's only like this. Now, a scenario where this is RE. So like in this scenario of ours where we didn't have flotation costs here in equity, it's the same, but flotation costs were equal to 0 still. So it makes the retained earnings have the same cost of equity. I hope we click on that. I hope I lost you there. Okay, so it's the same as cost of equity because even cost of equity, we didn't have flotation costs, they were 0. So this is the same as this, ideally. But otherwise, on a normal question, usually flotation costs are given so that there's a difference. That you just substitute for div1, which is 360, then P0 as 4,000, and then G as 8%, you'd have the same answer. Okay, but here equity, in case we had flotation costs, then because you reduce P0, the resultant figure can't be the same. So that's what the difference is. Otherwise, it's the same as 17%. So I hope that is chap. We're saying retained earnings. You have 17%. Okay, then you got face value. The face value of retained earnings is 20 million. Okay, then proceed. We have debentures. So debenture, we had the cost of capital as, let me check. Yeah, debt debentures, had it as 14.9%. Okay, then the first value will be the normal one, which is 10 million. Okay, then bank loan. Okay, the loan or the term loan. This value is 12,000. Okay, the specific cost of the loan was still computed it. Said it was 9.8%. Okay, so once you're done with that, you've done step one, now you're going to step two. Step two, like I said, it's the proportion. Okay, so the proportion needs us to give us totals here. So I need the total here. When you add these, what do you get? So this is 16, 36, 46, 58, 500. Okay, you can confirm with me in case I'm right. Then proportions, like I already said, just get the specific item divided by the total. Okay, good. Divided by the total. So it is 15 m divided by 58.5 m. And you have 0.256. Okay, you can use 3 decimal places or 4, depends on you. Okay, then the next one is 0.017. Okay, the next one is, yes, if you're using a calculator, the easiest thing is you change the front figure only. Okay, then you're faster. This is 0.334. Then you have 10 m 0.171. Okay, then you have 12.5, 0.14. Okay, so that's how we get the proportions. When you add them together, it's supposed to get at least 1 point something. Either one, it's supposed to be 1.0. Okay, but in case of rounding off, you may have 1.02, 1.01, but it should be around 1. Okay, so that's how we get the proportions. Okay, together, then now you get the weighted average cost of capital by multiplying the proportion by the rate. Make sure that the figures you have on the calculator, you remove them and type these very ones. Because if you're saying 0.256 times 17% is still a figure. And then for you, on your calculator, you have 0. What? Let me see. You have 0.256410256. Yeah, that figure is not the same as what you have written there. Okay, so always retype the 0.256 times 17%. You don't have to put the percent, just say times 17. Whatever you get, you just put the percentage on it. So it is 4.35%. Okay. Then you go to the next one. So 0.017 times 15.4. Okay. Then you have 0.26%. Okay. Please try to press these figures, calculators. Make sure that you're getting them. They are not as easy as they look. Okay. 0.342 times 17. Okay, 0.171 times 14.9. It's 2.55. Then I add percentage. Okay, then 0.214 times 9.8. You have 2.0%. Okay, then after getting each of those, then you just add them together. Okay, so still you type them the way they are. So 4.35 plus 0.26 plus 5.81 plus 2.55 plus 2.1. Okay, I have 15.07%. So that is how we get. Any questions on this one? I can just scroll it down so it's a bit organized. Okay, that's how we get that. Re-echo on how we got the weighted and the proportions. Okay. For the proportions, we are saying that you get the face values of each item, like the way they were given in the question, and then you add them together to give the total. Now the proportion is given by the face value of that particular item, in this case, say equity capital, over the total for all, which is 58.5. That's how you get the proportion of 0.25 for equity. For preference shares, it will be the 1 million divided by the total 58.5 million. Then you have 0.16. Then you do the same for the rest. To give you the weighted average cost of capital, you're saying you get the proportion times the specific cost of capital, which is here. You got them from step 1, what we did earlier. You have this answer here, 4.35%. In case of equity, if you get 0.256 times 17%, you have 4.35%. You do the same for the others, then later you add them together. So the weighted average cost of capital is this one, the one here, the one in bold. Okay, guys, I beg to stop here for cost of capital. So let's look at the question on capital budgeting and then call it a night. Okay. So this is a question I got. So capital budgeting. Capital budgeting, I don't want to go through steps. I'll just do as we see, since I think you already have an idea that you need to know the 3 classifications of cash flows under capital budgeting. I have the initial cost, you have intermediate cash flows, then you have the terminal cash flows. Okay, so this was the question given. Okay, they want you to generate relevant cash flows and then assess the project using the NPV. Okay, and you're given the rate. So on a normal day or on another day, they will give you this information, but the rate, you have to compute weighted average cost of capital to get the rate. Okay, that's on another day, but in this case it was given as 12%. So here is the question. So we're going to just, for those who, I think you all have these questions. This is year 2015 or 2016, 13th July 2016. Okay. FM. Okay, go. Okay, so I'll read, I'm not going to share the question. So kindly get your copy because I'll be reading as I transfer it to my worksheet for purposes of time. Okay, so I hope you can see my worksheet because I've shared it. Okay, so shall have initial course. Then you have intermediate. Then you have the terminal. Actually, the terminal is under intermediate last period. Okay, the expression I can give you on this. Initial costs, usually these are costs you incur before you start the project. Okay, costs you incur before the project commences. Before you begin, if it is a machine, before you begin using it. Costs you incur until the machine is ready for its intended use. To the extent that even the testing period is not included as a cash flow later, but used as initial costs because you're trying to test this machine so that it's ready for use. So any costs you incur in any project before the project gets ready for use or for its intended use, they all fall under initial costs. Okay, so that's what I can say about initial costs. Then for intermediate, these are cash flows, or they can be inflows and outflows at the same time that we either get or incur during the period when the project has commenced. You have begun like operating officially. You have begun harvesting, okay, from the investment. That entire period is what we call an intermediate period. In the terminal period, it refers to the last year or the last period of, actually the last year of the project or the investment. Any cash flows you generate or spend all fall in the terminal year or the terminal cost. Okay, that's the main difference between initial cost, intermediate, and terminal. So let's look at the question and see if you can answer a few questions. So I'll be reading from what I have. I hope you already also have your own. Okay. So Makerere Swimming Club, MSC, is considering constructing a new swimming pool worth 20 million. Now you're hearing, okay, that you want to construct a pool. So the project is the pool. Once the pool is ready, then whatever cash flow from the pool or spend on the pool, once you begin using it for operations or for business use, then those become intermediate. But before the pool is ready for use, that's initial. Okay, so they're saying constructing it to make it sure that the pool is there. It's 20M. Okay, so that's what you call invoice price. Others call it, I don't know, but it's basically the price you're going to incur to construct the pool. So 20M, okay, in order to increase on its capacity and revenue. Then they're saying that the initial cost of excavating the pool or the ground pool, wall fence, fitting, and installations will be done at 8 million, 12 million, 3 million, respectively. So let me take those to my worksheet as I read them. Okay, so we're saying you have the invoice or the sales invoice. The invoice cost is 20M. This one is no negotiation, saying put them down. Okay, 20M. Now let me put these figures just in 20s since they're in millions only. These are in millions. Okay, then we have what you call capitalized expenses, costs that we incur in bringing an asset in its present state and condition. Okay, those are additional costs, but capitalize them. Call them capitalized costs. Capitalized costs. Okay. So these ones included things like installation, clearing of excavation. Then you had fittings. Then you had installation. These were given as 8M, 12M, 3M. Okay, now these make a total of the whole thing, of the entire initial cost when you add them together. Okay, so why we add them together is that you can't use the pool. For example, you wouldn't do what? You wouldn't, for instance, put the carpet. I think, is it carpet or cement? Whatever they put in the pool. Some pools use carpet, others use is it cement? Yeah, you can't put the cement in the pool if you have not, for example, made the hole, what you call excavation. Okay, you need to make the hole. You can't put the water, for instance, without you putting the ceiling, or if it is, in this case, the carpet. Okay, you can't do anything with swimming pool in case you don't do installations of maybe there are those holes that empty the swimming pool, that help in refilling. Yeah, if you don't do all that, you can't use the swimming pool. So that's why they're all under initial costs. Okay, the other items that fall here, like if you have, for example, any opportunity cost. For instance, the land that you're using for the swimming pool. If you had another project that you would use the land for, maybe you had maybe agriculture, and agriculture would maybe earn you 5M, for example. Okay, by you opting to use the land for a swimming pool, we are saying you're incurring an opportunity cost of 5M that you will get from what? From agriculture. Now, in that case, it would increase the cost of the entire swimming pool. Okay. Then the other cost that you can look at is if you have tax incentives or government incentives. If the land was given to you free by the government, you didn't spend on it, that figure is not a cost, but rather an incentive. So it will reduce the initial cost. Okay, among others, I don't know if you've come across any other you would share, then I explain. But this is what you have in the case. So you're done with initial cost. Then if you continue reading, the case says that